To all those inquiring in the inbox about our Forex mentoring program, please accept my apologies for the delay in my response. Allow me to introduce the FITS1 program, which stands for Fundamental, Intermarket, Technical, and Sentiment Analysis. This comprehensive program consists of 82 downloadable videos covering fundamental aspects of macroeconomics, such as central bank policies, economic indicators, and much more. The FITS1 program is priced at 2,000 pesos and serves as a fundamental building block for understanding market dynamics. Continuing, we present the FITS2 program, an extension of the FITS1 program. It comprises over 100 podcast tutorials providing detailed insight into the application of theories from FITS1. The primary focus of this program is to help traders understand the market narrative and effectively integrate it into their trading strategy. FITS2 also sheds light on the importance of inter-asset analysis, technical market narrative, and how sentiments can be utilized to strengthen existing trading strategies. Given the complexity of the topics covered in FITS2, fundamental knowledge gained from FITS1 is essential to comprehend its application. The FITS2 program is priced at 6,000 pesos and is ideal for traders seeking to elevate their trading strategy to the next level. Now let's go back to our weekly Forex market overview. Looking back this week, the Lunar New Year festivities in China resulted in a notable absence from the market, leading to reduced liquidity conditions compared to usual. In the UK, data presented a mixed picture, with the labor market demonstrating resilience, particularly in wage growth, despite a slowdown in inflation. Consequently, traders are slightly less certain about the likelihood of an interest rate cut by the BOE in the first half of the year, with approximately a 60% discount according to OIS pricing. A disappointing Australian jobs report raised concerns about a decelerating economy in Australia, potentially attributed to higher mortgage rates exerting pressure on economic activity. Meanwhile, in the United States, inflation exceeded expectations both at the consumer and producer levels, prompting some market analysts to question whether the elevated price pressures might be influenced by seasonal factors. The sharp decline in U.S. retail sales in January sparked speculation about a potential slowdown in consumer spending. Conversely, retail sales in the UK surpassed expectations. Despite the notable inflation readings and weak retail sales in the US, indices finished the week either at or near record highs, indicating resilience in the market. The Australian and US dollars emerged as the strongest major currencies, while traditional safe haven currencies like the Swiss franc and Japanese yen struggled amid a preference for riskier assets. It has indeed been a volatile start to the year, marked by notable shifts in economic expectations, interest rate projections, and market dynamics. The past week exemplified this trend, with inflation surpassing forecasts while retail sales took a dive at the beginning of the year. This complicates the Federal Reserve's task of determining the appropriate timing for rate cuts. The mixed data since the last Federal Open Market Committee (FOMC) meeting adds further intrigue to the release of the meeting minutes scheduled for Wednesday. While a rate cut in March seems unlikely, insights from the minutes could shed light on policymakers' current stance. The US dollar experienced a positive week, strengthening after data revealed that inflation in the US is not moderating as swiftly as anticipated by investors. Consequently, expectations of imminent Fed rate cuts were unwound, bolstering the dollar's value through the interest rate channel. Robust economic growth, a tight labor market, and persistent inflation create a challenging environment for the Fed to justify rate cuts. Market sentiment has adjusted accordingly, with the timing of the first rate cut now projected for June, and the total number of anticipated cuts for 2024 reduced to less than 4, down from an earlier estimate of 6. As rate cut expectations diminish, the dollar has regained momentum, appreciating by 3% against a basket of currencies since the beginning of the year. This trend is notable given the prevailing optimism in the stock market, as positive risk sentiment typically undermines the dollar, traditionally considered a safe haven asset. The recent rally in the dollar underscores its resilience and aligns with its strong economic fundamentals. This trend may continue, especially considering that the market is still pricing in more rate cuts than the Fed has signaled. Investors eagerly anticipate insights from the latest Fed meeting minutes, seeking clues about the potential timing of rate cuts. Despite some officials advocating for patience, emphasizing the strength of the U.S. economy, a consistent message in the minutes could further bolster the dollar's momentum. March has largely been dismissed as the probable timeframe for initiating interest rate cuts by major central banks, but upcoming data next week could alter this expectation for at least one bank. The European Central Bank, ECB, appears to be closest among its counterparts to initiating an easing cycle. While market odds of a rate cut remain low, they could increase if there's a substantial revision to Thursday's January inflation data. With the Eurozone on the brink of recession, even a slight downward revision could prompt the ECB to contemplate rate cuts, given that headline and core CPI are nearing the 2% target. Thursday will bring PMI figures for the Eurozone, Germany and France, providing a current assessment of economic conditions and prospects for the region. These surveys currently indicate contraction, so any improvement, even if still negative, would be viewed positively. Turning to Europe, Thursday will also see the release of PMI business surveys for both the Eurozone and the United Kingdom. Both economies have been grappling with stagnant growth, with the UK even slipping into a technical recession late last year. Investors will scrutinize these surveys for indications of improving or worsening conditions, which could influence expectations regarding the timing of interest rate cuts by central banks. Despite strong UK inflation, markets perceive the Bank of England as likely being among the last to cut rates in this cycle. This sentiment has supported the British pound, currently the second best performing major currency this year, after the US dollar. However, the pound's resilience could be tested by stock market volatility or further deterioration in UK data, especially amid political uncertainty ahead of a general election. It's been a volatile week for the British pound against the US dollar, particularly following some bearish developments earlier in the month. The breach below the neckline of the topping formation, approximately at 1.26, seemed notably bearish, as did the subsequent bounce off a significant Fibonacci level. However, despite this week's rebound, the momentum has waned before reaching the lows of February. In the Eurozone, although narrowly avoiding recession, the outlook remains bleak. Persistent declines in new business orders over the past 7 months signal potential challenges for future growth. If upcoming surveys confirm this trend, confidence in ECB rate cuts in April could strengthen, potentially impacting the euro. Additionally, Thursday will see the release of the latest ECB meeting minutes, although their market impact is typically limited. Next week we'll see a flurry of economic data releases, drawing keen attention from traders, especially given recent developments in other regions. Across the board, expectations for monetary easing have been tempered recently, with the Bank of Canada not anticipated to initiate rate cuts until July. However, weaker inflation and retail sales figures next week could potentially accelerate this timeline. Starting with Canada, Tuesday will bring inflation statistics for January. Inflation has markedly cooled in recent months, with December's core CPI rate dropping to just 2.6%, prompting the Bank of Canada to abandon its tightening bias. Another decline in inflation could heighten the likelihood of a rate cut in the spring, exerting pressure on the Canadian dollar. Additionally, Canada's retail sales data for December will be released on Thursday.